Overnight, the sentiment has been largely upbeat. US equity futures are showing a clear green hue across the board. The S&P 500 futures, our broad market barometer, are firmly in positive territory, indicating a resilient undertone. Not to be outdone, the technology-heavy Nasdaq futures are showing an even stronger push higher, suggesting that the tech trade continues to capture imagination and capital. Even the small-cap Russell futures are participating in this optimistic early morning rally, pointing to broad-based confidence. But the real story unfolding this morning, the one that's truly capturing the attention of every major player, is the seismic shift at the helm of the most powerful financial institution in the world. Kevin Warsh is the new Federal Reserve Chairman. This appointment alone has sent ripples through every asset class, setting the stage for what could be a dramatically different era of monetary policy. We'll be diving deep into what this means for your portfolios and the global economy. As the sun rises here, the financial world is waking up to a landscape that feels both familiar in its resilience, yet fundamentally altered by this pivotal leadership change. The appointment of Kevin Warsh as the new Federal Reserve Chairman is undoubtedly the dominant headline across every financial desk this morning. His track record and past statements suggest a potentially more hawkish, data-driven, and perhaps even unpredictable approach compared to his predecessors. Markets will now be intensely scrutinizing his every word, his every appointment, and every nuance of his communication style. What does this mean for interest rates? For inflation? For the trajectory of the US economy? The answers will dictate much of the coming year's investment strategy. Meanwhile, other titans of finance are weighing in. Jamie Dimon, ever the pragmatist, offered a succinct message to business leaders lamenting economic woes, essentially urging them to focus on solutions rather than complaints. His 2 words speak volumes about the need for resilience and proactive leadership in an evolving economic landscape. In the crypto world, the perennial debate rages on. Michael Saylor, the staunch Bitcoin maximalist, continues to champion its revolutionary capabilities, touting its ability to transfer any amount of money anywhere on Earth in minutes, even on a bank holiday. This vision of a truly global, permissionless financial system resonates with a growing segment of investors. However, his longtime critic, Dr. Doom, Nouriel Roubini, remains steadfast in his dismissal, blasting Bitcoin as bogus and a systemic risk. This ongoing clash of philosophies highlights the fundamental divide in how different financial minds view this nascent asset class. And for those tracking the cutting edge, Cathie Wood continues to double down on her conviction in disruptive innovation, strategically acquiring significant stakes in mega-cap artificial intelligence stocks. Her focus remains squarely on the long-term potential of AI to transform industries and create unprecedented value. These are the voices shaping our understanding of the markets today, and their insights, often contradictory, demand our careful consideration. The bond market, the often overlooked nervous system of global finance, is reacting with particular sensitivity to the news of Kevin Warsh's appointment to the Federal Reserve. His reputation for prioritizing price stability and potentially advocating for a more disciplined approach to monetary policy could signal a shift in the outlook for interest rates. We've seen strong US economic data recently, better than expected GDP growth and a robust jobs report, which on its own would typically put upward pressure on yields as the market anticipates a less accommodative Fed. Now, with Warsh at the helm, the conviction behind that expectation intensifies. Long-term yields will be under the microscope. Will Warsh lean into the hawkish interpretation of strong economic data, signaling a quicker path to tighter policy, or will he maintain a more nuanced, data-dependent stance that could still leave room for flexibility? The initial reactions suggest an underlying caution as bond investors try to price in the unknown elements of a new Fed leadership. The bond market is a forward-looking beast, and right now, it's peering into a future shaped by a new hand at the monetary policy tiller, trying to discern the exact rhythm of future rate moves. Expect increased volatility and recalibration as this clarity emerges. The central bank narrative is dominated by the epochal news from the United States. Kevin Warsh's ascension to Federal Reserve Chairman marks a defining moment for global monetary policy. His past commentaries and public stances suggest a potential pivot towards a more orthodox and inflation-focused approach. This could mean a renewed emphasis on controlling the money supply and a willingness to be less dovish than markets have become accustomed to. The implications for future interest rate decisions are profound. Remember, just recently, Federal Reserve officials were discussing various rate hike scenarios at their last meeting. With Warsh now in charge, those scenarios could take on a sharper, more definitive edge. The bond market will be particularly sensitive to any early signals from his team regarding the pace and magnitude of future policy adjustments. Across the Atlantic, the European Central Bank is also facing its own brand of uncertainty. Whispers of Christine Lagarde's possible early departure to head the World Economic Forum are leaving investors pondering not just replacements, but the continuity of the ECB's current policy trajectory. Will her potential successor maintain the current course, or could we see a shift in the approach to tackling European inflation and economic growth? This leadership flux injects an element of nervousness into European markets, even as US futures paint a rosier picture. And we can't ignore the recent macroeconomic backdrop that sets the stage for these central bank decisions. The US economy grew way more than expected in the third quarter, signaling remarkable resilience. Coupled with a stronger than expected jobs report, the economic data presents a robust foundation for a Fed that might feel empowered to take a firmer stance against inflation. However, persistent US inflation, which US News and World Report recently highlighted as still bad, provides the imperative for this vigilance. In the UK, inflation data saw the pound continue to decline against major currencies, underscoring the ongoing battle against rising prices globally. All eyes are now on these pivotal figures and the institutions guiding their economies. Turning our attention to the essential building blocks of the global economy, commodities are exhibiting a fascinating interplay of supply, demand, and geopolitical influences. Gold, the ultimate safe haven asset, is showing a noticeable surge overnight. This move comes despite a generally positive sentiment in equity futures, which can sometimes mute gold's appeal. Its climb well above recent price levels could be signaling a few things. Perhaps underlying geopolitical tensions are creating a persistent bid for safety, or investors are increasingly viewing it as a robust hedge against ongoing inflation concerns, especially as central banks grapple with evolving monetary policies under new leadership. The outlook from analysts suggests prices remain well below record highs, implying there could still be significant upside potential if these factors intensify. Crude oil is also ticking higher, propelled by significant news regarding US inventories. Recent data shows a sharp plunge in US crude oil inventories, following what was previously a massive build. This suggests a renewed strength in demand, potentially reflecting a more robust industrial and consumer outlook globally. Any drawdowns of this magnitude typically inject bullish momentum into the oil markets, as it signals a tightening supply picture relative to consumption. Natural gas, on the other hand, presents a more mixed picture. While some regions, driven by colder weather, are seeing strength in cash prices, overall spot prices are showing a blend of gains and losses, particularly in Western markets. This indicates a more localized, weather-dependent dynamic rather than a broad-based shift in the underlying energy landscape. Meanwhile, even the more niche commodities like sugar are consolidating recent losses, reflecting the fluctuating supply and demand patterns in agricultural markets. The commodity space, therefore, tells a story of diverse forces at play, each demanding careful observation. Let's zoom in on the specific sectors and individual stocks making waves this morning, offering a glimpse into where capital is flowing. Animated chart. Amazon, top performer. Our top performer overnight, commanding significant attention, is Amazon. This e-commerce and cloud computing giant is showing a powerful upward momentum in futures trading. This isn't just a minor bump, it's a clear signal of renewed investor confidence in its dual engines of growth. The resilience of its e-commerce platform, coupled with the relentless expansion and profitability of Amazon Web Services, continues to impress. The market is clearly anticipating robust future performance, particularly in the cloud infrastructure space, which remains a bedrock of enterprise digital transformation. Amazon's ability to innovate and expand its market share, even in a competitive environment, is truly compelling. Animated chart, MicroStrategy, worst performer. Conversely, our most notable underperformer this morning is MicroStrategy. This is particularly intriguing because it comes on a morning when Bitcoin itself is showing significant strength. Typically, MicroStrategy, with its substantial Bitcoin holdings, tends to move in tandem with the digital asset. So, what explains the divergence? It could be a combination of factors. Perhaps profit-taking after recent runs, concerns over its leveraged bet on Bitcoin's volatility, or simply a rotation of institutional capital into more direct or less volatile crypto plays. The market is evaluating the nuances of its unique business model, especially compared to the direct appeal of Bitcoin itself. Beyond these individual movers, the technology sector as a whole continues to demonstrate remarkable strength. Giants like Nvidia, riding the unstoppable wave of artificial intelligence, continue their upward trajectory. Microsoft and Google are also showing healthy gains, underlining the ongoing demand for their cloud services, software, and innovative AI solutions. Cathie Wood's recent purchases of megacap AI stocks reinforce this narrative. The AI revolution is not just hype, it's a profound shift attracting serious capital. Even in the electric vehicle space, Tesla is showing resilience. Despite broader market uncertainties, the company continues to command investor attention, with a headline even suggesting option strategies designed to harness its range. And on the institutional side, the concept of whale watching comes to life with reports of BlackRock making a massive bet on companies like Nebius Group, indicating where sophisticated players are deploying significant capital. The underlying message here is clear. Innovation and robust business models continue to attract investment, even as specific narratives like MicroStrategies require a closer look. The digital asset space is vibrating with excitement this morning, and the star of the show is undeniably Bitcoin. Against a backdrop of mixed global sentiment, Bitcoin is demonstrating impressive resilience and strong upward momentum. This surge comes even as traditional US markets are closed, underscoring the 24/7, truly global nature of cryptocurrency trading. Michael Saylor, the indefatigable proponent of Bitcoin, often speaks of its fundamental utility, the ability to send any amount of money anywhere on Earth in minutes, even on a bank holiday. This core proposition, coupled with increasing institutional interest and growing mainstream acceptance, continues to fuel its ascent. The narrative around Bitcoin as digital gold or a hedge against inflation and economic uncertainty seems to be gaining traction once again. However, we must address the intriguing divergence we noted earlier. While Bitcoin powers higher, MicroStrategy, a company deeply intertwined with Bitcoin's fate through its substantial holdings, is pulling back. This highlights that while the underlying asset may be strong, specific investment vehicles and their unique valuation metrics are still subject to market scrutiny. It could signal a preference for direct Bitcoin exposure over corporate proxies, or simply a re-evaluation of MicroStrategy's premium. This strength in Bitcoin also acts as a direct counterpoint to long-standing critics like Nouriel Roubini, who has repeatedly labeled it bogus and a risk to the financial system. While the debate rages, the market's actions speak volumes, with Bitcoin showing a robust performance that defies many of its detractors' predictions. It's a testament to the persistent belief in its long-term potential and its evolving role in the global financial architecture. As the European morning progresses and we look towards the eventual opening of US markets, the trading day ahead promises to be exceptionally dynamic. The overarching theme will undoubtedly be the market's digestion and reaction to the new Federal Reserve leadership under Kevin Warsh. Every pronouncement, every interview, every hint of his strategic direction will be analyzed for clues on future monetary policy. Investors will be seeking clarity on his stance on inflation, employment, and the overall trajectory of interest rates. On the macroeconomic front, while we've had recent US inflation and jobs data, the market will remain incredibly sensitive to any upcoming releases or revised figures that could further inform the Fed's next moves. Keep a close eye on any preliminary whispers from the Federal Reserve itself, perhaps through regional Fed presidents or other officials, as they begin to align with the new chairman's vision. Corporate developments will also play a role. While the market is closed, major players are still in motion. We have reports of Walmart stock being eyed ahead of its Q4 earnings on February 19, laying the groundwork for how retail giants are performing. The airline sector is also in focus, with Southwest continuing its flight path as UBS foresees significant payoffs from new fees, indicating sectoral shifts and efficiency drives. Finally, always remember the broader geopolitical landscape. Ray Dalio's recent warning of the US becoming a tinderbox after fatal immigration shootings serves as a stark reminder of underlying social and political risks that, while not directly tied to daily trading, can affect market sentiment and risk appetite over time. The key for the trading day ahead is to remain agile, informed, and responsive to a market that is fundamentally recalibrating in the wake of significant leadership change. As we wrap up this morning's financial briefing, the overarching narrative is one of a global market in flux, yet remarkably resilient. The appointment of Kevin Warsh as Federal Reserve Chairman is a game changer, setting the stage for a potentially more disciplined era of monetary policy. While US futures signal an optimistic start to the trading week, the bond market is already recalibrating, anticipating the implications of a new hand at the Fed's tiller. We're seeing strong economic data out of the US, a surging Bitcoin defying critics, and select tech giants continuing their impressive climb. Yet, beneath the surface, there's a careful reassessment of strategies, particularly in the crypto space with MicroStrategy's divergence. The message is clear: the financial landscape is evolving, demanding vigilance, adaptability, and a keen understanding of the new forces shaping our markets. Stay informed, stay strategic.